Hi everyone, welcome back to the Market Chat. My name is Richard, and joining me today is my guest, Kris, also known as @FromValue on Twitter, and he is a growth stock investor with a marketplace on Seaking Alpha called Potential Multibaggers. Kris, welcome to the show. Thanks for being here.
I'm enjoying being here already, so I'm glad I'm here. Thank you for inviting me.
Oh yeah, my pleasure, my pleasure. So I always like to start things off with learning a little bit more about my guest background. So I know you're a little bit different than most people. You don't have a traditional finance background. So yeah, would you mind telling us a little bit about your journey and yeah, your evolution as an investor as well?
Yeah, well, the first 36 years of my life, I can summarize them in just one word: nothing. I mean, as an investor, then, you know, I'm from Belgium, so I have a European background, and I live in Belgium as well. So, and you know, here investing is less popular, let's call it that, and I don't have a traditional background, you know, with parents or so or family who invested. The only things that I heard about investing were stay away because it's so dangerous, you can lose all your money. And well, for the first 36 years of my life, I actually did nothing, not even retirement. So, you know, we have a quite high fixed retirement here, and especially if you have a job as a teacher, which I had. So I have a background in languages, English and Dutch, and also media. So I studied media and communications as well. After that, and I started working at the local television station for a year and a half or so. Then I worked in the Belgian Parliament for 3.5 years, and then actually I had, you know, we have the Flemish Parliament and the Federal Parliament, and you know, the French Parliament as well, or French-speaking part of Belgium. And the MP I worked for moved from the Federal to the Flemish Parliament, and I had to bridge, you know, 5 or 6 months or so, because the elections were not at the same time. Very strange, but that's how I went into education, and I liked it so much that I stayed for almost 15 years. And since last year now, I work full time on Potential Multibaggers. So that's my professional background. So looking back on investing, I was not interested actually in investing, like, you know, maybe a lot of people are not, if they don't have, you know, family who talks about it, or taught on school or something. Then in 2013, my wife was pregnant, and I had a primal feeling of having to gather for our unborn child. And that's how I started to get interested in investing. But my first thought was not investing in stocks, but in single malt whiskeys, because I also organized whiskey tastings back then. But my wife didn't really like that idea, and she thought, well, that I would want to taste those exquisite whiskeys, and I would want to open them. And then I said, yeah, maybe 2 bottles, one to invest, one for myself. And you know, a good single malt to invest in starts from, let's say, $500 to $1,000 or so, and higher too. But also, it's not very liquid. You know, well, it's liquid to drink, but it's not a liquid thing to trade. And you have to find the right buyer. And I also thought of art, paintings more particular. But that's even worse with liquidity and you know, and also, you know, so some things are in vogue and others are not, and that's in whiskey and that's in art. And then I kept searching, and I found stocks, and yeah, I got interested, and you will already hear my first mistake there, because I have made a ton. As you can think, if you're starting out without any background knowledge. I said to my wife, oh, you already have stocks of which cost less than $1. So that was my very first mistake, penny stocks. And then a lot of other mistakes followed. Option gambling, going on margin way too much, and getting margin calls after margin call, buying companies or stocks of companies that I hadn't heard of because, but I had read one article about, or
Right.
Then what value traps. Also, then I all of a sudden from a penny stock investor, I want to become a value investor, and in those first 2 years, actually, I lost money, and not too much because my wife didn't trust me that much yet. So she said not too much at the time, which was a very good thing to say looking back. And that as a percentage, I lost a lot. I don't remember how much, but a lot. But I have always been someone who's stubborn, and also someone who learns, or who loves learning, studying, and I wanted to know why I failed and it didn't work out. When I saw that a lot of people, were successful, and I also saw, I was a bit of a value investor then, a bit off because I was not a great value investor. And I thought, well, if I look at Amazon is no value stock, but look at that growth. It's
Right.
incredible. And that's when I started to look at other investments who had that, multi-bagger characteristic, like Netflix, for example, or Apple, I started distilling certain elements that they had in common, and that's actually how I started working on Potential Multibaggers. Now, it took a while to be able to become myself. Why? Because I had no training at all.
Right.
So you're in a new field, and what you think you have to do is as far away from your personality as possible, because I was not a math guy, so I thought I had to do DCFs. So, and I did a lot of them, and of course I learned a lot of them, but it didn't feel right in a certain way. It didn't feel like me. And then in February of 2017, I heard a podcast interview with Tobi Lütke, the founder and CEO of Shopify. And I thought, well, man, this guy is so incredible. He has such a vision. He's so smart. I have to have shares. I have to have a position in Shopify. And I immediately bought my first shares at 58, something like that. And then I saw, oh man, this is, and I was surprised. I wanted to be the rational guy, and then I hear an interview and I immediately buy shares. I started wondering why, and I thought, well, this guy, comes across as so capable, and that's not just for me. I'm pretty sure that other investors will think the same, right. And I'm pretty sure that his employees will think the same. And then I thought, well, I don't see that human element enough in investing, and that's exactly what I'm good at, because I have always worked with people, and I enjoy it. And then I thought, well, I have to use that knowledge as well, and look at what humans can. You cannot count human capacities like leadership and vision, etc. You cannot see that in numbers in any way, and that was clearly one of the things that all those great stocks had in common. If you look at Jeff Bezos, if you look at Steve Jobs, etc. And I saw the same thing in Tobi Lütke, and of course, it was a great investment. And I have added a few times over time, and it was the first potential multi-bagger pick back then in May of 2017, and then I was on a roll. I still enjoy myself so much because I have the feeling that what I do is who I am, and I think that's very important in investing. I don't think there's. I heard in a podcast of Patrick O'Shaughnessy that there are 300 ways to beat the market consistently. But a lot of people jump from one to the other, and I understand that. I did that for a few years as well. But you have to find your own way. If you really are a value investor, I mean, great, and probably you will have success over the long term. I'm not. I'm someone who's enthusiastic about the future, and I see things in the future that make me enthusiastic, and I want to be a part of that company which thinks about the future. And so I think how you invest should reflect who you are, and that's very important.
Absolutely. I know. I completely agree, and it's awesome to see how you evolved and made all those mistakes, but you had that perseverance to study yourself, actually go out and study the different stocks and companies that you saw were doing incredibly well, and try to find those common characteristics. That's very similar to what William O'Neill, whose methodology I kind of follow. He went out, studied the best winning stocks going back to 1800s, and distilled all those different characteristics into CANSOM. So that's very cool. As a part of your journey, were there any particular books that you found really helpful and that you think new growth investors should go ahead and read to kind of help build their foundation and hopefully shorten their learning curves? Are there any titles that come to mind?
Well, let me start with a false start. The one book that everybody should read starting investing is, of course, The Intelligent Investor,
right?
Benjamin Graham. I read it and I hated it. And I hated it so much because of the same thing. It didn't express who I am. Right. He talks about taking a last puff of a cigar butt that you find. I mean, that's not what I become enthusiastic about. And I was actually very disappointed. And then shortly after that, I found Peter Lynch, One Upon Wall Street. And that was something that I could identify with. And even more, Come Stock and Come Profit, Philip Fisher. And that was also important in my in my turnaround to a growth investor and in my approach for potential multibaggers. So yeah, those books were very important. Also, the book 100 Baggers by Kris Mayer. I could go on, and the important thing about books is, I think that you shouldn't follow a book because it's from the past. But what you should do is distill the knowledge that is in the book and integrate it in who you are and how you think about investing. And Kris Mayer in his book has a few points that I don't agree with, but it's a great book, and I've read it twice.
Right.
So it's like in real life, I think, where you see people who are examples, and you pick up something there, and you borrow something there, and that's how your personality grows over time. And I think for investors, the same organic process should happen. And the more you dive into it, the faster that will be the case. And I read literally thousands of articles on investing, especially on Seaking Alpha, and that's also how I started on Seaking Alpha. Then I first read, and then I made comments, and then those got longer and longer. And at a certain moment, somebody said, your comments are as long as an article and more interesting than most authors. Why don't you start writing? I thought, well, that's maybe a good idea. And so I became a contributor, and then later I started my marketplace on Seaking Alpha, and that's my writing story. And so I've learned a lot from all those articles as well, also the really bad ones, because you start seeing when you're new in investing, everything seems convincing, and it's only when you see the two opposite sides that you start to see, what the truth will be probably somewhere in the middle, but probably more to one side than to the other, and that's what you learn if you read a lot of articles, and the more bad articles you read, the more or the easier it becomes to recognize a bad article from afar. So that's also an investment for later, that you don't have to read them anymore. So yeah.
Cool. No, that's great. And I guess now we can kind of delve into your strategy and an investing thesis. So why don't we start with kind of your trademark phrase, from growth to value? What does that kind of mean to you?
Yeah, well, the thought then was, I was still a bit of a value investor, but not really. But I thought, if you take growth stocks, like for example Amazon, and you hold them long enough, they become value stocks. I call Amazon a value stock right now. I'm sure most value investors won't agree, but I do, and that's where my name came from. So I really thought, I want to invest for the long term. I want to keep those winners. I want to hold them so long that they become value stocks, actually. And that was the thought behind my moniker. And yeah, I mean, I really still try to live up to that expectation, in that sense that both I try to hold as long as possible, as long as the thesis doesn't change, I won't sell. But also I look for companies. I mean, I really do deep research, and I know that that's a cliche, but I write 5 articles each time, about 5,000 words on each or so, to really and to make sure that my multis, I call them multis, the potential multi-baggers subscribers, the multis, really know the company, right, and know what they maybe will buy or not. And if you want to hold for a long time, you need conviction, and conviction can only come from knowing what a company does very well. If you don't know that, if you don't know the people behind the company, if a stock falls 30, 40, 50%, you'll sell, of course. And but if you know the people, you can even be happy if a stock falls 50%. And sometimes I'm cheering, yeah, go down more, go down more, go down more. But yeah, that's what's behind my name, from growth to value.
Very cool. And I guess let's talk about when you went back and analyzed all those different stocks, the Apple, the Amazon, the Shopify. What were those common elements that now you really look for in new ideas and new opportunities?
Yeah, there are quite a lot, actually, and I've even added quite a lot over the years. But one of the things that I saw very early on was what I call the 3 O's. And the 3 O's are owning, overachieving, and over-delivering. And owning is actually, I want management that is on the same page as me as an investor. So we have, so I want them to have a meaningful stake in the company. There are exceptions sometimes. It's not a hard rule, but in general, I look for that. And the best companies have always had that. If you look at Amazon, if you look at Netflix, if you look at Apple, etc. And then overachieving is they try to do something which sounds crazy and which can be mocked easily. That may sound strange, but if a mission of a company can be easily laughed about, then it has my attention. Right. Of course, there has to be more than just a mission. The numbers have to show that the company really lives up to its mission, and that it's not just words, but more action than words. But let me give an example. Amazon already said very, very early on, we want to be the most customer-centric company in the world. Wow, I mean, that's overachieving, right? Cloudflare, a more recent example, mission statement: we want to make the internet better. Wow, and
Right.
you can laugh with that, but if you look at what they're doing, they're actually living up to that.
Mm-hmm.
So overachieving and reaching for the stars is actually really a common theme there as well. And then over delivering is, each time they over deliver on several, earnings, of course. So if they beat the earnings expectations, that's always a good thing, because people don't realize that if you compound those earnings beats, that becomes huge over time.
Right.
So, stocks compound and people understand that, but beats compound as well, because, maybe you beat by 5% revenue, then 5% or 7% or 10%. If you do that year after year after year after year, that's an incredible thing, because suppose, a company has 100 million, it guides for 100 million of revenue, it guides for 125 million next year.
Mm-hmm.
And it delivers 132 million. So that's 7%, a beat of 7%. Now, what will the analysts do? They will take that into their accounts or their projections for the year after that one. So they will be higher. If they beat that again, 7%, it looks the same, but it's actually even more if you look at from the starting point,
Right.
initially that 100 million. So it compounds, and especially if you take that effect for 5 or 10 years, it's incredible what it can do, and it can completely change the picture of a company. And also another element. So those were the 3 O's. Another element is innovation, and that sounds easy, but you have to see that a company is obsessed with trying to serve their customers as good as possible, even beyond what normal companies want to do. You see that Amazon, let's take the same examples, Amazon and Cloudflare. If you see what Amazon has done over the years, it's incredible. And even there, you see almost always 2 things: very obvious expansions, like Amazon was in books,
Right.
CDs at the time was, and DVDs, that was, obvious. AWS was not.
Right.
But that's from starting all those microservices, because in the year 2000, Jeff Bezos wrote his famous 2 pizza letter, which said that there could be no more meetings where you needed more than 2 pizzas. So, and he created smaller teams.
Mm-hmm.
But of course, there were a lot of practical problems there as well, because what do you do if you have a giant code, for example, that you all work on together? Well, you split it up in very, very small parts, and you get some sort of microservices.
Mm-hmm.
And then at a certain moment, Amazon also started to sell those inside of the company. If you wanted something, you had to calculate the cost of that, even if it was inside of the company. And in that way, they wanted to improve the efficiency.
Right.
And if you see those kind of things, and that's where AWS came from one such, it's very easy to say, oh, we have a small team here, 3 people, 5 people, maybe. Let's try something out. Oh, we have tried this out. It looks good. Can we have a go? Oh yeah, sure. 2 or 3 weeks, and let's see what you get. And then after those 2 or 3 weeks, if it looks good, we can have, you can get some more budget there, and that's how AWS started, actually. So it's incredible what innovation can do. And if you then Cloudflare, if you look at Cloudflare, what they are doing is really innovation as well, in that sense that they launch and then make it better. So really the approach of Clayton Christensen, the author, the professor and author of The Innovator's Dilemma and The Innovator's Solution was the other one, I think.
I'm not sure.
Yeah, I think so. And Matthew Prince, the CEO of Cloudflare, actually had lessons at university lectures of Clayton Christensen, and the one who helped writing Christensen's books is an employee now of Cloudflare. So, and what is the theory of innovation is that it comes from the bottom, not from the big established players. It comes from a smaller player. Why? Because it doesn't have to be quality. It doesn't have to be great because people don't expect that. It's it's just for a small part of the audience, for example. And that's how Cloudflare also works internally. They they just launch, and then they have a huge database of free users, and those free users give feedback, and that's how the company improves and improves and improves and improves every single product. And last year they launched 550 new products and features.
Wow.
And they said that they would accelerate that this year. So yeah, so innovation is very important. Is a very important element as well. In total there are about 15 characteristics. So it would take too long to to talk about all of them. Yeah, I think those are very,
the main
very,
ones.
Very central. Yeah, you always have to look very well what problem a company solves and how and how it does that.
Right.
So, for example, let's take FIVR, another potential multi-bagger pick. If you look at FIVR, you see innovation in that sense that people have talked for years. Oh no, it's Upstart is much better. Not Upstart.
Upwork.
Upwork is much better. That's the quality. FIVR is low quality. What can you get for $5, etc., etc.
Right.
But what you see is that just because of that, they are better and they are ahead, and they have a lot more features than Upwork, and they were considered as low quality, and that's typical for innovation as well. So yeah.
No, very
Those
cool.
are a few, but I could ramble on for a few hours about the characteristics of potential multi-baggers.
Absolutely. Is there a specific market cap that you're focused on? Because obviously once you're at Google, Amazon size, you can't grow as fast. Versus if you're much smaller, you can kind of have that hyper growth that we'd like to look for.
Yeah, I usually try more than 1 billion. I typically don't take sub 1 billion, because then there's a lot that you don't know about the company and the CEO and the execution, and there's simply not that much information out there. And also because they're smaller, they're probably in a smaller market or not proven yet. For example, they could have great technology, but it's it's pre-revenue, for example, and
right.
That can be interesting, and I put that on my watch list. But I want to see, not just if it works, because even if it works, you have to be able to sell it, and execution in sales is extremely important and often underrated, I think. So more than 1 billion. And typically sub 10 billion, but typically, because it really depends on the total addressable market.
Right.
So C Limited is, I don't know exactly at this moment, but it will be something about, I don't know, 110, 120 billion market cap right now. I could still see Limited go 10x over the next 10 years and more.
Right.
Because their total addressable market is so huge. I mean, this company has written 1 trillion plus market cap all over it, and so it really depends on the market, the total addressable market then. And also, maybe I should have said that Potential Multibagger is meant for the next 10 years, 10x, so at least. Of course, it can go much faster. Shopify has done it in, I don't know, it was in 3.5 years or so.
Not too bad.
Not too bad, right? But it won't be that each time. And
right,
how stocks are, they're very unpredictable, especially over the shorter term. And that's one of the beautiful things of the stock market. I think that it's easier, not easy, but easier to predict over the longer term than over the shorter term, while everything else in society is the other way around, right?
Very cool. And I've read some of your articles. They're very detailed and excellent.
Thank you.
No problem. Could you discuss a little bit and go into detail about your kind of 3 different categories of growth stocks that you believe people should have in their portfolio, but also, of course, the percentage of each depends on your own personal situation. As you said, your portfolio should reflect yourself, your time frame, all of that. So could you discuss that a little bit?
Yeah. So I have 3 buckets actually, and I don't think people should have those. I mean, it's like you say, some of the multis have only potential multi-baggers, and the other 2 categories are budding anchors and anchor stocks. So let's start with potential multi-baggers. I have already said that's 10x at least in the next 10 years. Then you have budding anchors. Then you have anchor stocks, the biggest category, and those are the Amazon, Salesforce, right. Adobe, those kind of companies that I think will still beat the index, meaningfully over the next 10 years, but not, go whatever X. And then you have budding anchors, and that's a category in between a bit. They still can go 10x, but it's a bit harder because they're already bigger, and they should do at least 5x over the next 10 years. And those are companies like, for example, Peloton. I see Peloton as a great budding anchor at this moment. And the allocation between the 3 is, it depends again. I used to have a bit more anchor stocks, than I have right now. I think right now I'm about 10-12% anchor stocks there, and probably 20% something budding anchors, and then the rest potential multi-baggers. It used to be more. I think I had about probably I come from probably 30% anchor stocks. So it depends on how you feel and how confident you are, and also where you are in your life. And I have a few fantastic multis who are in their 80s and still invest the potential multi-bagger way, and that shows, I think, that they have the potential to become 100 and older, because they're so active still. And I just got I think I shared it on Twitter as well. I got a message from an 85-year-old who still works 15 to 20 hours a week.
Wow.
And who invests in potential multi-baggers, and that already shows that I think you should really invest how you are and how you think, how you feel comfortable, and for me, I've become more comfortable owning less anchor stocks and more potential multi-baggers, because the drawdowns don't, it's some people never learn it, and some people have it quite fast to live through those big drops,
right.
which sometimes happen. And potential multi-baggers have a lot of volatility. Volatility is actually one of the other characteristics I talked about, because volatility, you need volatility to have a multi-bagger, which might sound strange, and that is because if people talk about volatility, they usually talk about volatility down, but volatility goes both ways, and you need those, you need those extra high moves up as well. And so yeah, but of course, if the market drops by 25%, a potential multi-bagger will go down 50 or 60%. So if you're not able to withstand that, and to be actually a bit enthusiastic about that, because you know the company very well, and you want to buy as much as possible for the long term, then it can be hard, and then it's better to have to have Amazon, which is maybe just down 20% or 25% like the market. Right. So it really depends on who you are as an investor. People often put that in categories of when you're younger, when you're retired, but I think that it really depends on yourself. And as I said, so the oldest multi is 87, and he's still investing for the future, which I think is great. He says, well, I always say invest at least for the next 3 years, because usually the stock price follows the fundamentals over 3 years time. So, and yeah, he says, 3 years is no problem. I'm investing for the next 10 years at least. So isn't that great? I mean, such messages really made me happy.
That's awesome. And in terms of your overall stock selection and companies you're interested in, what kind of themes over the next 5-10 years are you really focused on? And what are the themes that you think will bring upon the most disruption, the most innovation, and along with that, provide the most opportunities for fantastic companies to emerge and develop and grow, and hopefully the stock price will continue?
Yeah, I think that's a very, very hard question. And the reason is that, we see themes right now, but we don't see the themes of, 2027 or so. Right. So that's very hard. Of course, the obvious ones are, e-commerce, for example. And one of the potential multi-bagger characteristics is what I call unscaled scalability. And that's a theme which becomes more and more important, but that's not just a theme in one industry or so. But unscaled actually mean, I took the term from Heman Tunisia. He's the founder, co-founder of or was the co-founder of Livongo. He's behind HAAC right now, the SPAC, right? Together with Glenn Tallman. So also Livongo. And unscaled, he has good, I think I've read it 3 times, that book, and I normally never reread it. That's why I remember Unscaled, and that's why I remembered 100 Baggers, because I think I haven't reread maybe 10 books, or not even that. So, but Unscaled has really had a huge influence on my investing, in that sense that it showed me that everything we want right now as millennials and younger is unscaled, and unscaled means adapted to our own needs, personalized, as it were. You don't want the cookie cutter solution anymore. You're not, I remember that my parents said that they were so happy when they were young that they got a Coke. But, do you know anyone who gets really, really happy because he or she gets a Coke? I don't think so.
Really, no.
It's just a general product, right?
Right.
And it's so normal. But if you go to Starbucks and you get your coffee with your name on it, that's already a bit better. That's already a bit personal. And the more personal you can make something, and let's talk about tech, for example. Twilio has more than 1,000 products, and companies can select, I take this and that and that, right, and that, and that's I can integrate that into my own site. That's completely personal, and I don't have to do the boring stuff. And that's really completely, and that's the scalable part as well, because it helps companies to scale at a size that could have dreamed about even a decade ago or so. And that scalability is also very, very important. There are lots of EVs right now, or EV companies, and I'm hesitant to invest there. Why? Because I saw the story of Tesla, and there I looked at the financials and I thought, this is very dangerous. And then I was very happy to see that Elon Musk admitted that they were 1 month from bankruptcy, because that's what I saw in the numbers as well, and that's why I didn't invest. Of course, I had better done that, but I don't regret it, because I could only look at the information at that time as it was. But in general, of course, EV is a great theme, but who will be the winner, except for, of course, Tesla? That's not that clear. And there are several companies that I follow there, but I always try to look for the clear leader, and the clear leader is definitely not the first one. If you look at Apple and the iPhone, the iPhone was not the first smartphone,
right?
But it was the first leader, and that's where I wait there to see which themes play out. The themes are actually not that difficult to spot, but it's very hard to see who will become the leader, and that I have learned over time as well to wait a bit there to see who really becomes the leader. And but again, to name one of the things, one of the areas that I think innovation will continue to grow at a very high speed, or actually start to grow at a very high speed, is healthcare right now. I think healthcare and education are two industries which have fallen a bit behind in the innovation that we have seen over the last decade. So they are not really completely on the cloud, and they have not seen that same rate of innovation that all the rest of even old industries have seen. And so I think in healthcare, you will see that unscaled part come in much more. And I'm waiting for the first big company which says, Richard, we will take your genome and look at what the best food is for you, the best exercise. Here you have a complete plan here. Be careful with, I'm allergic to milk, so I will say milk. Because but also goat milk is no problem, and it's better for you to exercise at 8 in the morning and not in the evening as you do right now. And information about yourself that's personal, and that's perfectly scalable because you can do it for everybody. And it's also very unscaled because it's very personal for you. And this is the diet that you follow best. Be careful. Red meat is not good for you. You should never eat it because you have this and that and that. That possibility for cancer or whatever. So I think there is a lot of innovation possible there, and I think there will be multiple winners, of course. Heman Tanisha, he says that there will be at least 100 billion market cap companies in healthcare in that way, and I really believe him. I think they're they have they're later, but they will go faster in healthcare, I think. So that's a very interesting, and of course, I mean, there are lots of other interesting industries as well. But I wanted to talk about healthcare. Why? Because you see the problem. I see what I think will become big, but it's not easy to spot the obvious leaders there. That's why I still wait a bit. But
very cool. And it is tough to spot the leaders within an industry. Are there any characteristics that you find a lot of the leaders within a particular theme share, or is it really just too difficult to identify the leader?
Well, those potential multi-bagger themes actually. So those three O's, the overachieving and thinking so big, and that can fail miserably. But if you see in the numbers that they live up to that promise, that's something really important. And then the other part, owning, okay, but also the over delivering.
Right.
So both on the innovation. If a company like C Limited, for example, even before I think, well, that's something they could do, they already have it. And if you see that in a company, that's a great sign, especially if they also are fast to kill it. If they try it out, if it works, great, they will greatly promote it in all kinds of ways. If it doesn't, they just after 6 months, it's gone. Right. And that's what I always see in leaders. They have great products. They think about their customers. They don't think that much about themselves. They really think about, what can this do for our customers?
Absolutely.
So that customer centricity is very important as well.
Agreed. I was really interested when we talked in our kind of logistics call before we actually started recording, and you mentioned the human element, and that's something that you really focus on. I found that really interesting because my own process, I look a lot at the revenue growth, the earnings growth, not so much at the management. So I thought it'd be really interesting to I guess get a little bit more detail about how you analyze a particular CEO, and how much that can do to a company, and especially if they're such a visionary like Elon Musk. Of course, he had success before Tesla and SpaceX. Maybe that factors into it, prior success before the original company. I guess my question is, what are some frameworks and ways that you analyze a particular CEO and basically determine whether he'll fulfill those huge goals that a lot of these visionaries have?
Yeah. It's not so simple because, if I would ask you, can you describe me the characteristics of, a good friend? It's not so simple because it's just that human element that also plays such an important role. And of course, if your girlfriend or your wife asks you, what do you love about me? It's such a difficult question. I mean, it's the total, and then people say, oh, it's your beautiful eyes. I say, oh, I don't care about that. I mean, it's what we have as humans that we can feel from each other and we can pick up. And if you look at people and you ask 100 people and you put somebody on a stage, and you that person has to talk for 1 minute, and then afterwards you ask those 100 people, was this person someone you trust, someone you like, someone you would want to work for? I think if you would look, I think 95% would have the same answers, because we as people, we know that. So that's why it's hard to put it in a framework. And yes, one of the things that I really look for is, if they promise something, how long does it take before it becomes reality? And that's also something Jeff Green is great in that he has done some predictions, and he said, I think this will happen, and then 18 months later, ta-da, it's there. And it's not just about his own company; it's also about his industry.
Right.
So he has been talking about the disappearance of third-party cookies, which Google has announced now for, I think, at least 2016. So I mean, those kind of things show that people have a passion for something. If you are passionate about something, you can convince other people, but you also know more because it's your life. And that's people feel that. People know that if you would ask someone else to write an article on a particular stock, who has never done that before, and I would do it, it would be clear to everyone. And if you would ask what's the difference, it's sometimes hard to put your finger on it, but you will know the difference. So it's a bit an evading answer, I know, but it's so difficult to put it into a rational framework.
Right.
It's very difficult to put something irrational, because it's irrational or call it human skills, into a rational framework of, it's always a reduction if you put it in a framework, and that's what I try to avoid.
Understood. Absolutely. And getting into, I guess, the numbers that you look for: revenue growth, earnings growth, valuation. What are some kind of baseline metrics that you want, I guess, most of the companies that you're investing in to have when it comes to revenue? And how does valuation at that current time play into things as well?
Yeah. So revenue is the most important one. Revenue growth. Why? Because if you look at the long term, and I invest for the long term, then you see that revenue growth is the most important driver of stock price growth, or stock price growth. And if you look at 1 year, it's the multiple that counts. So higher or lower multiple, probably higher. If you look at 3 years, and then we're back at, for me, the long term is at least 3 years, then you see that revenue takes over. And if you look over a period of 10 years, revenue growth is already 74% of the stock price, or the, they're connected for 74%, and then 11% is margins. So I also look at gross margins, because they also, you always have to put something into a context. I think that's very important, and I think you know that. And if you look at valuation, then valuation must be put into a context as well, because if you have a company, with a PS ratio of 60, let's call it an extreme example. If that company grows at triple digits, and it is projected to grow at triple digits for 3 more years, that's actually, and it has gross margins of 85%. I mean, I would buy it. So it really depends on a combination of several factors, and I think I named the most important ones there in that example.
Absolutely. So you're not considering something's expensive versus what it's doing now. It's the taking into account the projections, the margins, all of that into the future, and what it could be worth then. That makes perfect sense.
Yeah, and I also look at the history in that sense. How much do they beat?
Right.
Because if they miss their earnings, and they do less well than projected, I don't want it. If the projections are 30%, and if I look back and I see that their guidance each year underestimates their real earnings by 10%, I mean, I'm comfortable with 30%, and I mean, of course, I'm comfortable with 30%, but I mean, I'm comfortable that they will completely beat those 30%, and be around 40%. And often you see that stocks are also valued like that. And I think in general, I as I said, I did those DCFs, and then I read that I don't remember where, but DCFs are like a telescope. If you move them just a little bit, you're in a completely different universe. And that's completely true. And I think that a lot of investors, and I was there too, are a bit too arrogant in their valuations. It's worth this much, but not that much. I mean, I would always be I am always very careful there. There could be things that I don't know. There could be things that, and of course there are obvious things sometimes. When I saw Nikola, it was obvious to me. A more recent example was Plug Power. When it was so high, I said to the multis, I don't see the quality there, and they don't beat the earnings. They miss them often. So that's not a stock that I would want, for example. So valuation is, I also scale in over time very, very, very slowly. What I mean is this: if I see a great company and I think maybe it's a bit expensive, I just start, because of all the criteria that I use, valuation is not a part I use it in my last article as the very last point, because I think that's the place where it should be. And if you look at quality first and valuation last, I think you will do great. And too often I see that people, postpone, oh, if it drops to this, I will buy it, but it never drops to that. And then, the next year or so, they take a higher, if it drops to this, and then higher and higher. Or you often see that if a stock falls, let's say 20% or 25%, the bottom is still very often higher than what it was at a year ago or so. So that's why I already start a small position. I start with a position of 7% or 10% of what I see as a full position, and then I scale in over months, and sometimes even and often even more than a year, and sometimes even years, because if I see that a company executes so well, I want more of it. So yeah, that's how I think about valuation, as very, very difficult. And I see the attraction that a lot of people love about valuation, because it's simple. It's a number, and all right, it's undervalued right now. Okay, now I can buy it. But it's just guessing. And I really, sorry, but I really always have to laugh with price targets, which are so. I always say to my subscribers to the multis, if you want to know my price target, write down 15 prices between this and that. Take a darts board and throw your dart, and that's my price target. So it's really that. It's really. I don't think that price targets should be taken seriously. It can say something about, I think this company is doing great, but I think I have spoken to analysts, and they don't like it either, but they
Have to.
they have to, yeah, because that's what brings their company into the media, right? The price targets. So not they're often very good analyses, but the price target, that's the headline, and that will probably remain the same thing. Too many starting investors look at those price targets, or the consensus or whatever, as something which has a basis in reality, but I don't think that is the case.
Makes sense. And going back to overall portfolio construction, how many stocks, how many companies do you own? And what are your thoughts on diversification versus concentrating on just a few companies and knowing a lot about those particular companies?
Yeah. Again, I will say I think I have 32 positions right now. And again, I think that we have to go back to the same principle of let your portfolio reflect who you are. And that can be, I'm really, I'm obsessed. I have to be honest. I'm obsessed with stocks. So if I have 32 positions, I know them very well. Maybe someone else says, I don't want to invest that much time, but I want to have the best of the best of the best. Maybe 7 positions is great then. I'm very aware of diversification, so taking too much positions. But if you look at the percentage of stocks that beat the market by over their lifetime by more than 500%, that's what was it again? I think 6 point whatever. If you look at the total number of stocks, that's hundreds and hundreds of stocks. So if you really look for quality, you can have probably 50, 60, 70 positions over time. Because if you don't sell, of course, the number of positions grows, and still have enormous quality there. Diversification, by sector is a way not to go, I think. So I really don't see the sense of investing. Oh, I don't have energy. I don't have financials, I don't have this or I don't have that. I don't see, or telecommunications or REITs or whatever. I don't see any value there unless you just want to have a portfolio that reflects the market, of course. Then you really have an index fund, and that is
Right.
better to just put it into an ETF so you don't have to work. So, I want to beat the market, so I only want the best companies, but I think everybody should know how many positions you have. I sometimes hear that you cannot beat the market with more positions. I mean, that's not true. Peter Lynch did almost 30% a year for 13 years in a row, on average, of course. And he had 1,000 positions. And his collaborators or his employees said that there was no stock that Peter Lynch didn't like. So I think as long as you let your winners run, and as long as you really are very critical about the companies that you have, and I sell, I said that I want to hold for the long run, but if I see a company with deteriorating fundamentals, I sell it, and I'm patient. And I understand certain things, and every company has a hard time every now and then, as long as they as long as they own it, as long as they say that they will change it, I don't have a problem with it. Of course, they should show that in the results as well, of course. But if I think of Zoom, they had some safety issues when the pandemic hit, and then Eric Yuan said, I screwed up, and I really like that I screwed up, not we as a company. Or you could have said, oh, but we had to scale from what was it, 10 million to 200 million users a day. That's the reason. No. He said, I screwed up, and I really like that, because I am a Zoom shareholder. If he hadn't lived up to his mistake, or to the mistake of the company, I mean, I could have sold, because there were a few other things there as well, and the China thing. So some of the data went through a Chinese data center. So yeah, I mean, that's very important. I think if a company doesn't live up to the expectations, if it's no longer the quality that you want, I mean, you have to throw it out, and that's one position less than again.
Makes sense. And when a company of yours or a company you're interested in reports earnings and you're listening to the call, what are the kind of top 5 things that you're focused on and you're most interested in? And what do you kind of consider when a company of yours reports earnings?
There's no list again. I mean, I just listen as I listen to you now, which means that we're humans, and I listen to another human, and you can often hear something in the voice as well when a CEO talks, if he's confident or not, or maybe overconfident, which is also not what you want to hear.
Right.
But of course, you listen to the content, and if they beat the earnings or revenue, great, of course. But I still want to have a bit of color there. What are the trends, and what can we expect from the future? That's very important. So which products are growing? What are the maybe the possibilities for the future that they don't work on yet, but they could? They often sometimes refer to those things shortly, but you can hear it. So yeah, I mean, in general, it's like people listening to this, they will get information from this. If they watch all your interviews, it would be difficult for them to say, oh, I only listen to those 5 things. I listen to everything, and then I distill what's important for that specific company there. And that depends on the industry. That depends on if I also have been a shareholder of Novocure for a few years, and if I then I will listen to what they say about the trials of their product and their sales and those kind of things. And then for Cloudflare, I will look at what they say on what the new products do and what their margins are, etc., etc. So not one fixed set of things, but I listen to everything and then I distill what's important for that company in that specific industry.
Makes sense. And you touched on this a little bit earlier when it comes to volatility and risk and everything. What do you do as a portfolio manager and an investor to manage your risk and make sure that even if one investment goes badly, that your overall portfolio remains intact and you can come back from that?
Yeah. So first and for all, one thing I don't agree with, and we talked about this before. I've read the book Random Walk Down Wall Street by Mel Kiel, and I hated that book. I really hated it. It made me angry, actually. And my multis will know that, and my wife knows for sure I'm a very calm person. But that book really could make me angry. And the reason is that he in a very arrogant way, he says, just put everything into an index fund and that's all you have to do because you cannot beat the market. And that already makes me angry. And then a few of his assumptions as well. And one of the assumptions that I don't agree with is that volatility equals risk. I don't agree at all. Risk to me means the permanent loss of money. Permanent loss of money, not temporary, because temporary, if you read the book 100 Baggers, you'll see that all 365 100 baggers and more, of course, all have had drawdowns of 50% and more, not a single exception. And most have had it several times, and most have had 70% and more. So volatility is just one of the things that is inherent, but it doesn't mean that it's risky. Of course, if you need your money in next year to build a house or so, whatever, yeah, then it's risky. But you shouldn't invest it, in the stock market at all. Then just take something which is risk-free.
Right.
So, in general, I don't think the stock market is risky if you manage your portfolio well, and that was a part of your question. So what I do is portfolio size. So the allocation is I usually start with it depends a bit, but let's say 3 to 5% allocation that I see as a full position. So not the initial buy. The initial buy is, as I said, about 10% of what I see as a full position. So 0.3% or 0.5%. That's my first buy of my total portfolio, and then I build it out. And if I have a really high conviction in the company, and I'm building, and I see that the company executes very well, I go above my initial allocation of 5%, and I could go to 8% or so. That's the original allocation, right? And then that's it. Even if I still like the company, a ton, I won't add. But of course, if it does well, it will it will become 15% of my portfolio, or maybe 20% or so. And I probably won't cut it. It depends on the company again. Because if I see a deterioration of, sometimes the companies that you don't think it up, become huge winners, and sometimes that can be a problem that you're not that confident and that your conviction is not that high. Then yes, I think it's a good idea to trim. But if your conviction is still very high, and C Limited is the biggest position in my portfolio, I won't trim it. If it goes down 70%, I'll probably open a bottle of champagne. So I would be very happy to add a little bit even there, because it's still my biggest position. But if I see an opportunity like that, and probably that will be because of the complete market crashes, and then I would add to other positions as well, as I did in the last March. And I really pounded the table there for my subscribers, and I added, to Square, to Roku, to the Trade Desk, etc. Each 3 to 5 times or so, again and again. I put in all the money I could, because I saw that this is a historic chance, and such a huge crash so fast usually doesn't last. It's it's like the weather. The harder it rains, the shorter it will be. So yeah, that's why I went all in then. And by all in, I mean I have an emergency fund, and the first phase is that I don't add to it anymore, and the second phase is that I even withdraw from that emergency fund to put it all in stocks, and then I start adding to the emergency. And I don't take out everything. I leave normally at least 3 months. But last March it was only 2 months, because I thought that this is a great opportunity. And yeah, I mean, and then I don't I don't care too much for allocation anymore. What I mean is, if C would drop by 70%, it could still maybe be substantial part of my portfolio. I would have to count it, but maybe it would be still 5% or so, and I would add to 8% again. Definitely
makes sense. And how would you deal with an extended bear market like we saw in I guess 2000, but also 2007 through 2008?
Yeah, I would keep adding, and I add money to my portfolio every 2 weeks, and I buy whatever. If the market's high or low, I just buy, and in that way I dollar cost average in a way, but then not to my full portfolio, but into positions, right? Because sometimes people think that dollar cost averaging is only mechanical, your full portfolio, but not for me. So I mean, if you keep perspective, and I have a few articles written for my multis about stock market crashes. If you keep adding during market crashes, and you just keep, I always say that if the stock market goes down by 20%, you should add at least 50% more than you normally add to your portfolio. If it goes down by 30%, try to double the money that you normally, and do that by any means that you can, like I do from my emergency fund, or saving more, and no restaurant visits or whatever, but put in all you can at those kind of exceptional moments, and try to see them as opportunities. And yes, of course, I mean, I'm a human being, so I feel some pain as well. But at the same time, if I zoom out and I look at the yearly charts instead of the daily charts, you get a completely different picture. And if you look at the chart of any random 3-year period, you will see that it will almost be always up then over 3 years. And even if it wasn't, then people always are a bit too pessimistic, I think, about market crashes. What I mean is, for example, if you invested in the .com bubble in 2000, you would have to wait until 2013 before you had your money back. Well, excuse me, but if you put in all your money on the very worst day ever, you deserve to wait for 30 and nothing else anymore during the crash. You deserve to wait for 13 years, in my opinion. That's not how you should invest. Don't put it in. It's not gambling that, all in on black or whatever. So yeah, if you would have invested in at the very, I have made a calculation in one of those articles. If you put in $10,000 at the very worst day in 2000, and you added I don't remember, was it $500 every month then, or was it 1,000? I don't remember exactly which one I took, but after 4 years you were up, and quite well. And if you look at those 13 years of waiting until you're back to even, you had in just investing in the Nasdaq, right? No particular company or so, just the index. You had almost 14% CAGR over that period, even if you invested $10,000 at the very worst day. So I think people should zoom out and try to stay calm, and try to stay the course and follow the plan.
Makes sense. And you discussed this a little bit earlier about when you actually sell a company, but maybe you could provide an example of a recent example of a company that you actually had to sell because of the deteriorating fundamentals.
Yeah, and that one was AlterX. That's the last one I sold. Dean Stoker, the founder of AlterX, he was really a visionary, because he founded AlterX in 1997. And if AlterX works with big data in 1997, big data, I mean, right, that was probably somewhere on paper or so. So he was a really visionary leader, and his very first client was the mail service, snail mail, and because they had certain routes to do, and that could be made more efficient.
Right.
So I really like Dean Stoker, and last year he said, I'm retiring as the CEO. I remained executive chairman. All right, that's okay. I can live with that. You're still there, and it's still your company. You're still the biggest shareholder, and you have your say. And then Mark Anderson became the new CEO. I think that's his name, because I tried to forget it. But he came from Palo Alto Networks, and I researched him, didn't find any particularly negative things. Later I heard that, and I found on some forums that there were some things you could say about his tenure at Palo Alto as well, but nothing terrible.
Right.
But then his first conference call, he got the question, so when is AlterX coming with its cloud offering? And he said, we won't hurry it, because we will see once the customers want that, we will make sure that we will be there. And I thought, this is not good, because customers already want that, and besides that, you have to think ahead.
Right.
You don't want to be a follower, you want to be a leader.
Right.
And so I really didn't like that answer. And I forgot to say that at a certain moment I looked on Seaking Alpha, and I didn't see it because of that. I saw an article, pre-announcement of the earnings, and also new CRO, Chief Revenue Officer. And I thought, all right, okay. And then I saw some of my multis were angry and said, what's this? And then I looked at the press release, and the title was New CRO for AlterX. And then at the bottom, and these are our earnings. I mean, that's not the way to do it, right? That's not what you want. And that was already before those earnings, before that earnings call, that he said, we will be there once the demand is there. And then that CRO that he had taken on, that he came from Palo Alto as well, and so he knew him. And after 1 month and a half, that guy wrote a racist post on LinkedIn, and he had to leave again. And that was really it for me. I mean, If he wouldn't have known him at all, maybe, but no. So it's not just one thing, it's several things at the time. Of course, Alteryx has a problem with COVID as well, and it shows that, you know, it's a good to have but not necessary to have software. That also was a part of it. So it's all those things together again, as you know, it's a bit the theme here is context. So, and yeah, this was an example.
No, thanks, Kris, and that's awesome. I guess to wrap things up, I always like to ask my guests kind of what advice they would have for new investors just starting out today. What can they do to shorten their learning curves? What resources can they go out and read and gain knowledge from? So yeah, what advice do you have for new investors who want to start investing for the very first time?
I think it's very important to, and that's as I said somewhere in the beginning, I learned a lot from reading so many articles. And if I could do something again to even speed up my learning, it would be to purposefully look for the other thesis. So if I see a bull thesis, purposefully look for the bear thesis and read it very, very, very carefully, not just dismiss it immediately, but so trying to see the other side. And also, just try to soak up as much as possible from everywhere. As I said, I heard Tobi Lütke on a podcast, and I listen to a lot of podcasts and YouTube channels, of course. They should listen to all your interviews. But I say jokingly, but I really mean it, because there's a huge ton of information there, and I think that no student with a financial degree will know 10% of what somebody knows who has seen all your interviews, for example. I mean, it's the information is out there. Just look for it on Twitter, of course. Also, it's everywhere. You just have to, find your way. And also very important, as I said, try to find out who you are and where you fit in, what your style of investing is, and probably you will make mistakes. Don't worry. And as they say, it's not a loss. It's a learning moment. And without those learning moments, I wouldn't be here. And that's very important as well. Try to be mild for yourself if you make mistakes, and see them as a part of your process. Zoom out there as well, and look at the bigger picture.
That's awesome, Kris. And yeah, thanks for the shout out. I hope these interviews are good resources for people. So thank you.
Definitely.
Yep. Awesome. And where can people reach out and learn more about you and what you do? I know I'll have your links down below for Seaking Alpha as well as Twitter, but is there any other places that they should I guess look for you?
I probably should have said much earlier that there's a 2-week free trial for Potential Multibaggers. So if you go to just Google from growth to value, and you'll probably find me, or Potential Multibaggers, definitely. You can find me on Twitter at From Value. So yeah, those are my 2 main channels there. And in my if you would forget, you just can go to my pinned tweet, and you'll see the link there as well. So
awesome, Kris. Thanks again for your time. For anybody watching, thank you guys so much for tuning in. If you did enjoy, please go ahead and leave a like down below and subscribe if you're new to the channel, and we'll see you guys in future videos. Thanks.